Hi, this is Michael Reese, Certified Financial Planner, and I'm sitting here again with accountant extraordinaire Larry Flynn. How you doing, Larry?
Doing good, Mike.
Fantastic. Well, this is class 2 of our 3-class series, and in the last class we looked at just the basics, if you will, and we talked about how a person could go from $8,000 of annual tax to $500. And this was a person, if they never needed it, the money potentially, for nest egg money, what have you. And that begs the question, of course, Larry. Well, gee, how do you get from A to B, right?
That's right.
And so this is the first, the next two class, this class and the next class, is really about looking at some strategies and really talking about how do you go from paying a bunch of tax to paying a little bit of tax, getting from A to B. And in this class, we're going to cover that exact scenario that we talked about last time, which was the person that, maybe they'll never need the money. It's a nest egg. They might need it, but they don't know. They might need it. They might not need it. So why pay tax until the day comes that they do need it, right? So we're going to cover that scenario. And in the next class, we're going to cover the little bit more complex topic of how do you do tax planning when you actually need money today? You need income from your portfolio. How do you go about doing that, right? So let's just jump into today's discussion, which is planning. Doing tax planning when you may never need the money. Okay, so in order to understand how to do tax planning at all, you must understand these 4 buckets. So all investments fall into one of these 4 buckets. Now, the first bucket is what we would call our taxable bucket. So bucket number 1, taxable. And Larry, you talked about this in the last class, where these are accounts where you basically pay tax every year whether you use the money or not, right?
That's right.
And some of the things that fall into these accounts, what did you say, like CDs and go on?
Yeah, these are all our investment accounts, savings, brokerage accounts, anything that would not be retirement accounts.
So they get 1099s on every year.
There you go.
Right? Okay. So that's our taxable bucket, bucket number 1. And on the tax return, Larry, where do these items show up on a tax return? Which line items?
It'd be that interest and dividends, lines 8 and 9.
So 8 and 9.
Yep.
So this is lines 8. This bucket here, lines 8 and 9.
Mm-hmm.
All right. Now over here, the next bucket is our tax deferred bucket. Now, 3 general categories here. QRP stands for Qualified Retirement Plans. That's your 401k, 403b, 457, profit sharing plan, money purchase plan, simple IRAs, SEP IRAs, even regular IRAs. They all fall in that category. The next category there, NQA, stands for non-qualified annuities. Those are tax deferred. Larry, I just used the word annuity. Now, for most accountants, when I say the word annuity, what do?
They cringe.
Yeah, it's kind of an uncomfortable thing for them. But if I say the word mutual fund, do they cringe then?
No.
Stock?
No.
Bond?
No.
So why do they cringe when I say the word annuity?
They typically don't deal with them a lot. They don't know a lot about them.
So they don't understand them.
There you go.
Okay, so does that make them good or bad? Does it make them bad because they cringe?
No, not necessarily bad. They're just a tool.
They're just a tool. Now this comes, by the way, for those of you listening, Larry, he used to be president of the State Accounting Association, so he's not like some typical accountant. The guy knows what he's doing here, and I think you'll find, isn't it true, Larry, that most of the top accountants, they don't really cringe when they hear the word annuity because they view it as just another tool in the toolbox.
That's right.
Okay. I think that's important because a lot of times retirees, they hear what the media says and they hear that word and they don't get an objective perspective, do they?
That's right.
All right. And then we have savings bonds. A lot of people have money in savings bonds. All right. And by the way, I don't want you all thinking that I'm here to push annuities necessarily. It's just that Larry and I, we view every tool is just a tool in the financial toolbox, and we don't think they're good or bad. We just think that as long as they're used in the proper circumstance, then they work fine.
That's right.
Right? All right. Then we have our tax-free bucket. That's bucket number 3. These are, I'm sorry, before I go on, now like qualified retirement plans, when that money comes out, where does that fall on the tax return? Which line?
Line, what is it, 15?
Yeah, 15, right? So these are our 8, 9, and 15. Now we go to tax-free. Tax-free, there are only 3 things that are tax-free out there. Roth IRAs. Larry, when we hear Roth IRA, how do we feel about that?
We love Roths.
Oh, why do we love Roth so much?
No rules.
No rules. It makes me think of that commercial, no rules, just right. You know,
That's
Outback,
right.
right? Roth IRAs, yeah, that you can put, I mean, no taxes. You can pull money out whenever you want. No required distributions. We love that. Next on the list is municipal bonds. Now, we kind of talked about that last time, right? Where the interest is tax-free, but it might cause some tax on your Social Security. So, but it's on there. And then life insurance. Now, life insurance properly designed, first of all, very, very few accountants really understand life insurance, do they?
Not really.
I mean, it's kind of like annuities. Don't really get them.
They might understand the death benefit. That
Kind
they
of
have.
term insurance,
Yeah,
right?
Sure.
But you start getting into life insurance, like companies use it, or you know, some more of the advanced planning. It's not really what they get into, is it?
No.
But still done properly, that's tax-free, right? So, and then of course the fourth bucket, that's for people with, it's both income and estate tax-free. That's for people with estates over $5 million for an individual, $10 million for a couple. I don't want to spend a lot of time there because that's not the majority of people, right? So we'll focus on the first 3. But here's the key. When it comes to tax planning, if you want your tax return to look better, if you want to pay less tax, you need, the way it works is all tax planning involves moving assets to the right. You don't have to move them all the way, but you have to go in this direction.
You mean they have to be a Republican?
You have to be a Republican. No. No, you don't have to be a Republican. That's just how the buckets are set up. If I did the buckets in reverse, you'd have to be a Democrat, I guess. No, this is not politically motivated.
Okay,
it's just
gotcha.
simply, that's the way the buckets are set up. Moving assets to the right. So buckets 1, 2, and 3, and so on. So let's take a look at what that means. So let's go back to our problem tax return here. This is the tax return that we started with. We have, you know, this is lines 8 and 9. And again, line 8 and 9 come from bucket, let's get back up here, bucket number 1, right?
That's right.
And then also in the tax return, we have line 12 or line 15 here, right? That comes from buckets number 2. So step 1 in our tax planning is, I'm on the wrong, there we are. Step 1 is to figure out how can we get rid of these items up here, right? Bucket number 1. What can we do about bucket number 1? That's step 1. So let's go back to our little slideshow here. And in order to get rid of the tax on bucket number 1, Larry, can you help explain what is this slide saying? What do we need to do?
Well, you know, when you're in your earning years, the obvious one is putting into qualified retirement plans. That's what we do. But now that we're maybe in retirement and we've accumulated, you know, our wealth and we're no longer earning, that's not going to be an option.
Right. We're not working. We can't put money into retirement plans.
That's right.
We're already retired. We're already there.
Right. So another tool would be maybe putting them into non-qualified annuities.
Okay. So you're saying that one option. Again, what did we say? We have to move assets to the right, which means that we have to go either tax deferred or tax free.
Mm-hmm.
And when the tax return, let's see, we can't use QR qualified retirement plans because we're retired. That leaves non-qualified annuities and savings bonds.
That's right.
So why did you say annuities and not? Why didn't you say savings bonds? What's wrong with those?
Well, are they paying anything more than 0 right
Yeah,
now?
I'm not sure. Yeah, so we're not getting anything. So one option is if we're going to go tax return, we have to use annuities.
There you go.
But Larry, you're an accountant. How in the world could you say the word annuity as a tax planning recommendation? I thought accountants hated annuities.
Well, I think they don't understand them, but if we're doing proper planning, they're a viable tool to use.
So they're perfectly fine.
Sure.
If they're used in the right scenario.
That's right.
Okay, fine.
And that's the key, used in the right scenario.
Yeah, in other words, it's like any tool. Like you don't use a saw to try to put a nail in the wall.
There you
right?
go.
So
There you go.
fair enough. So that's one option. And the other option is what? We could go all the way out to the tax-free bucket. So here, could we take somebody's personal accounts and put them into, well, we can't put them into a Roth, right?
No.
But could we put them into municipal bonds or into life insurance?
Well, municipal bonds, it would be an option if you thought that was a good investment. And today, the way things are going today, I'm not so sure. I think life insurance would probably be one of the better options.
So life insurance could be an option.
Sure.
I mean, how about that? You know, the insurance industry comes to our rescue, in essence, with some life insurance and non-qualified annuity options. This is the life insurance industry specifically, right? And again, it kind of goes back to not good or bad, they're options.
That's exactly
right. And if it's the right fit for somebody, fantastic.
Mm-hmm.
Okay, so let's imagine that we were able to take someone's regular accounts and utilize some of those tools. Let's see what kind of result we could get from that. You know, how would that help us? So again, where were we? We were at, well, what was it? $8,100 of tax. You know, and if we were able to just get rid of this stuff on lines 8 and 9, let's say we could do that. Whoops, I think I went one too many here. There we are. Got rid of lines 8 and 9. Now the IRA is still there, but lines 8 and 9, they're gone. Notice what that does to our taxes. It brings us from 8,100 down to 2,800. That's $5,300 a year, Larry.
That's significant.
Now, if that's all the further they went, do you think that saving $5,300 a year would be beneficial?
Over 10 years, that's 53 grand.
That's a pretty good number.
That's enough.
Do you think your clients would find working with you a happy thought if you were able to save them $53,000 in tax
Absolutely.
over a 10-year period?
Absolutely.
Yeah, I mean, if that's all we did, that would be a good outcome. But we're not done, are we? Right? Because, whoops, before I leave, if you notice, we still have that $12,000 there, right? And again, that's money that they may not necessarily need. So let's continue our discussion. Let's see if we can help out there too, right? So we've got that part squared away. Now we've got that line 15. So what can we do with the line 15, Larry?
Well, if we got IRA monies or qualified monies, we can put them into a Roth.
Oh, love Roth.
Love
And I noticed you've got the life insurance as an option still for that as well.
Well, sure.
So I guess it's a choice, but Roth is probably both of our number one choice.
Probably 9 times out of 10 would be the
Right.
better. Yeah.
Okay, fantastic. So let's say we took our IRA and we moved it to a Roth, right? What kind of solution might we get there? Well, let's kind of take a look and see what we have. Now we get rid of that. Now we've gotten rid of that one too. Look at this. We're all the way down to $500. So we go from $8,100 all the way down to $500. It's $7,600 a year. Now, over 10 years, it's $76,000. So, Larry, if your clients are thrilled with you for saving them $53,000 to the IRS over a 10-year period, how excited are they going to be saving $76,000?
Very exciting.
Now we're talking some real money here, right?
That's right.
So what have we done here? We said if we take somebody's scenario, we use a mixture of things like maybe some non-qualified annuities, maybe some life insurance, maybe Roth IRA, and some combination of all of that. We find that we're able to take someone from paying $8,000 a year all the way down to $500. And that's a really good outcome. Don't you think?
I think so.
Now, it's a pretty simple deal because it's a situation where someone didn't really need the money, right? Now, in our next class, so we're done with this class. In our next class, we want to talk about what happens if you do need the money for income now and next year. But for now, I think that's a pretty good outcome. Larry, any final thoughts?
Nope, I think we're good, Mike.
Alrighty, everybody. I hope that was helpful. Look for next class where we're going to talk about what do you do if you need income this year and next year.